Imagine a young boy in Newton, Massachusetts, curious about the world around him, observing how people shopped, how businesses operated, and wondering how money could grow. That boy, Peter Lynch, would eventually become one of the most legendary investors in history. Today, we're going to dive deep into his life, his strategies, and the genius that allowed him to beat the market consistently. By the end of this video, you'll understand not just who Peter Lynch is, but why his investment philosophy continues to inspire investors around the world. And trust me, his story is not just about numbers or charts. It's about curiosity, patience, and seeing opportunities where others see ordinary life. Peter Lynch was born in 1944 in a middle-class family in Newton. From a young age, he displayed a curiosity that went beyond ordinary childhood interests. Unlike most children who simply accepted the world as it was, Lynch constantly asked questions. Why do some stores seem busier than others? What makes certain products sell better? How do companies grow over time? His parents encouraged him to pursue his interests and supported his questioning nature. Lynch spent hours reading newspapers, business magazines, and books about investing, even as a teenager. By the time he was in high school, he was already thinking about how to make money grow and how to recognize businesses that had real potential. One anecdote from his youth tells how Lynch would visit local stores, observe which products sold quickly, and jot down notes in his notebook. He wasn't just window shopping. He was analyzing demand, customer behavior, and sales trends, the early beginnings of the invest in what you know philosophy he would later popularize. After high school, Lynch attended Boston College, where he majored in finance. Even during college, his approach was unconventional. While other students focused on exams and grades, Lynch wanted practical experience. He took an internship at Fidelity Investments, immersing himself in real financial analysis and learning from seasoned professionals. He observed that investing wasn't just about numbers. It was about understanding human behavior, trends, and the story behind each company. After graduating in 1965, Lynch officially joined Fidelity Investments. Here, he began to refine his skills in a real-world setting. He noticed that many investors relied solely on financial statements without understanding the companies themselves. Lynch took a different path. He combined rigorous research with first-hand observation. For example, if a new toy became wildly popular among children, he didn't just note the earnings report. He would visit stores, observe the sales, and talk to managers. Similarly, if a restaurant chain consistently had long lines while competitors struggled, Lynch would see a clue about management effectiveness and brand loyalty. This blend of empirical observation and data-driven analysis became the cornerstone of his investment strategy. One of his early lessons came from recognizing the difference between hype and genuine growth. Many investors were swayed by flashy headlines or rumors, but Lynch learned that real, sustainable growth comes from understanding the fundamentals of a business and its market. This principle guided him throughout his career and would later become the essence of his books and teachings. In 1977, Peter Lynch took over Fidelity's Magellan Fund. At that time, the fund was underperforming and investors were wary. Over the next 13 years, Lynch transformed it into the best-performing mutual fund in the world. Under his leadership, the fund averaged an astonishing 29% annual return, outperforming the market consistently. Lynch's success stemmed from both his unique philosophy and disciplined process. He categorized companies into 6 types. 1. Slow growers. Mature companies with slow, steady growth. These were generally low risk, but offered limited returns. 2. Stalwarts. Large, stable companies that grew moderately. They were reliable, especially during uncertain economic times. 3. Fast growers. Small, rapidly expanding companies. Risky, yes, but with enormous potential if chosen wisely. 4. Cyclicals. Companies affected by economic cycles, like steel or automotive manufacturers. Understanding the cycle was key to timing investments. 5. Turnarounds. Struggling companies that had potential to recover. Lynch excelled at identifying the signals that indicated a genuine turnaround. 6. Asset plays. Companies whose real value lay in undervalued assets, such as property or patents. By understanding these categories, Lynch could tailor his strategy, balancing risk and reward while seizing opportunities that others overlooked. At the core of Lynch's philosophy is the principle, Invest in what you know. He believed that everyday experiences could reveal investment opportunities that Wall Street might miss. For instance, if a new restaurant or retail brand suddenly becomes popular in your community, that trend might indicate a growing company worth researching. However, observation alone was not enough. Lynch emphasized fundamental analysis, which included studying earnings growth and revenue trends, evaluating debt levels and cash flow, analyzing price-to-earnings ratios and the PEG ratio. The PEG ratio, or price-to-earnings-to-growth ratio, was particularly important to Lynch. A PEG ratio below 1 indicated a stock was undervalued relative to its growth potential. He argued that investors should focus on companies with strong fundamentals that the market had not yet recognized. Another critical component of his approach was long-term investing. Lynch consistently warned against reacting to daily market fluctuations. Instead, he encouraged investors to focus on the underlying business. He often said, "Time is your friend, impulse is your enemy." This patience and long-term mindset allowed him to achieve extraordinary results over decades. Lynch also believed in intelligent diversification. While he managed hundreds of stocks in the Magellan Fund, he made sure he understood each company thoroughly. It wasn't about holding many stocks for the sake of diversification. It was about knowing each investment deeply, which minimized risk without sacrificing opportunity. Lynch frequently shared anecdotes to illustrate his principles. One famous example involves Taco Bell. Observing that new restaurants were always crowded, he researched the company, understood its growth potential, and invested early, before the broader market recognized its value. Another example is Ford Motor Company. While many investors were skeptical about the company's performance, Lynch noticed improvements in product quality and rising sales, signaling a potential investment opportunity. These stories highlight how Lynch's combination of curiosity, observation, and fundamental analysis consistently led to successful investments. He also emphasized that individual investors could outperform professionals if they applied similar methods. By using their personal insights, combined with disciplined research, ordinary people could spot trends that big funds might overlook. Beyond managing the Magellan Fund, Lynch shared his wisdom with the world through books like One Up on Wall Street and Beating the Street. These works made complex investing concepts accessible and actionable for everyday investors. He encouraged readers to trust their observations, verify the fundamentals, and not blindly follow market hype. Lynch's writing demystified investing, showing that success was achievable with curiosity, discipline, and patience. His books remain timeless because they address not just numbers, but the human side of investing, including emotions, judgment, and decision-making. From Lynch, modern investors can learn several crucial lessons. 1. Invest in what you know. Everyday experiences can reveal hidden opportunities. 2. Do thorough research. Don't rely on tips or speculation. Understand the company's fundamentals. 3. Think long-term. Avoid panic during market fluctuations. Stay focused on the business story. 4. Be patient. Great investments often require years to mature. 5. Stay curious. Observation and learning are as important as analysis. 6. Balance risk and reward. Understand the type of company you're investing in and tailor your strategy accordingly. 7. Avoid overcomplicating. Simplicity in understanding the business often leads to better decisions. These principles are especially relevant in today's fast-paced, information-overloaded markets. Lynch reminds us that calm observation, disciplined research, and patience often outperform short-term speculation. Peter Lynch's personal qualities were just as important as his strategies. He was humble, often walking neighborhoods and speaking with everyday people to understand trends. He was curious, always questioning, observing, and learning. He was also disciplined, consistently following his strategies rather than chasing market fads. These traits, combined with his analytical approach, made him not just a successful investor, but a role model for anyone seeking success in finance or any field that requires strategic thinking, patience, and insight. Lynch's influence extends far beyond the returns he achieved with the Magellan Fund. He inspired generations of investors to approach the market thoughtfully and strategically. By showing that individual investors could succeed, he democratized investment knowledge. Even today, His principles are applied by fund managers, financial advisors, and individual investors. His legacy lies not only in numbers, but in the lessons and mindset he passed on, proving that curiosity, observation, and disciplined research can consistently generate exceptional results. Peter Lynch's story is more than a financial success story. It's a story of curiosity, insight, and disciplined observation. His methods show that beating the market isn't about luck. It's about understanding the world around you, making informed decisions, and having the patience to see them through. So next time you notice a new trend, a crowded store, or a product everyone is talking about, think like Peter Lynch. With curiosity, research, and patience, you might just uncover the next great investment, just like he did.